I'm Jim Jubak, and welcome to my Trend of the Week video. This week's Trend of the Week is India is the new China. Obviously, this is not quite true. India is India, China is China. But in investment terms and business terms, what you're seeing is companies moving to India because they think they can get a better price for their goods. They're sidestepping the U.S.-China technology and trade war. So that, for example, Apple is very publicly looking for suppliers in India, or asking suppliers to move from China to India. And the idea is that they're shifting some of their supply chain from China to India. Other companies are following suit, and investors are doing the same thing. If you want to get in on this trend, two ways to do it. One is an ETF, and the one that I suggest is the iShares MSCI India ETF. Ticker is INDA. Here's the chart. And as you can see, this has basically been on a steady upward trend. This tracks the India economy. India is forecast to grow 6% this year. Moody says 6 to 6.3% growth, GDP growth in the June quarter. Reserve Bank of India is saying 8%. I think the Moody's number is probably more accurate, but this ETF is only up 5% year to date, but 10 or 11% in the last 3 months. So you get a big cross-section of India banks, India industries. The biggest holding is Reliance Industries, sort of one of the big India family conglomerates. Okay, the other alternative in stock, let's show you that chart, which is a much more interesting chart. Interesting is not necessarily good. This is HDFC Bank. It's the largest private bank in India. Ticker is HDB. As you can see, we're up. So for the year to date, we're looking at about the same kind of return as we got on the on the India ETF, about 5%. Here it's 4.5%. Up 8% in the last 3 months. It's not quite as much as the ETF. One of the reasons I like this one more is that India is not an economy that, all things considered, I really feel incredibly enthusiastic about investing in. It has an incredible reliance on coal and is increasing its reliance on coal, and I don't see that as being a good thing or sustainable for the world. The Indian economy is very, very, it's not a level playing field. I mean, it's basically dominated by family-run conglomerates, and they do really well when they have ties to the national government. And it's not, buying the whole Megillah makes me a little leery. I like HDFC, as I said, it's the largest private bank. I like it particularly because it is the biggest credit card issuer in India. It has about 29% market share for credit cards. Credit card penetration in India is still relatively low. So what you're seeing there is this credit card unit at HDFC Bank is really sort of participating in two things. One is the increasing wealth of the Indian consumer, and therefore more use of credit cards, but also the general technical development that as people can afford more technology, they have the ability to use payments in different ways, so that HDFC has this huge payments platform, either credit cards or other ways, including ATMs, to get people money, to get people involved. So it really does give you a way to go with the growth of the economy as a whole. The volatility is either a plus or a minus, depending on how you look at it. It's a plus if you buy at the bottom. If we can go back to the chart for a minute, you do see that there are severe bottoms that you could invest in. So if you buy then and ride up to here, that's great. The volatility is wonderful. If you buy up here and ride it down to here, the volatility is terrible. We seem to be in a slight downward move right now, but I think over the long term, this will, with greater volatility, track the Indian economy, and an ETF like the iShares India ETF So I'm going to add this stock. I'm probably going to put it in the volatility portfolio on my paid site, which means it won't go up on my free site at all. But hey, it's a good time to subscribe to my paid site. That's dewbackam.com. Normally we sell subscriptions to that site for $199. Right now, in honor of my mustache's 50th anniversary, we're doing a 50% off sale for another 10 days. So that's $99 instead of $199. You get 6 portfolios instead of the 3 on the paid, the free site. Free site is dewbackpicks.com. Certainly, I like the price on that one, free. You don't quite get as much as you get on the paid site, but hey, it's free. It's a good way to get a taste of what I do. If you like this video, please give it a thumbs up. And you can also subscribe to my YouTube channel. That way you get notification when we do the next one. That's also for free. We're doing about 3 a week, not always on the same day. So subscribe, and that way you'll find out when we're going up, and you'll never miss me. And as the song goes, how can I miss you when you won't go away? Okay, bye. See you next time.